Yo, what's up everybody? This is my second take of starting this live. I actually forgot my AirPods on the first one. And I actually got a message specifically from somebody yesterday evening saying, hey, we're totally down for your live being from home, but don't forget the AirPods. Make sure you got them in. So you guys have started making fun of me about that ever since I made a comment about if it's douchey or not. I feel weird. I really don't like working from home. Let's put that on the record right now. I want to be in the office. One, we pay that lease. Two, man, you don't want to spend the whole damn day in the house. And I'm just so unproductive here. I don't want to bring my extra monitor, my standing desk, and all that stuff. Age reveal. I'm 32. I've told you guys a long time ago. Yeah, I don't know. Working from home sucks. I don't know why so many people love it. I think it's really underrated. I think the go-getters probably want a dedicated space, right? And you guys are all going to trash me for that. But there's a special treat today. Since we're at the house, there's a really nice whiskey shelf over there full of lots of good whiskey. And whiskey that I would not bring to the office because Mike taxes me on all my whiskey. So I got a little nice bottle of Bowmore here that doesn't have much in it, right? So we're probably I'm not gonna finish that off. It's Friday afternoon, it's not Friday night. But we're gonna enjoy something a little special. Net worth reveal. Do you really wanna know? I don't know, 3.7, 3.8, something like that. And climbing very quickly. Maybe it's higher by now. I don't know. We'll see. Do you see how this stuff's not that important to me, guys? The Lambo, the net worth number, all that stuff. I don't think about it every day. I just kind of keep on moving on with the mission. Fine, Raj. Yeah, sure. Why the fuck not? It's all about the mission. It's not about being able to get on social media and brag about how much do I have of this, how much do I make each year. Look at the nice stuff I got. It's the stuff we do, right? And kind of the sport we play here, which is what this real estate investing game really is to us. And that's something that becomes really apparent when you talk to the ultra successful people. I talked to a guy on Tuesday that wanted to sell us an 84 unit in Milwaukee. And he came into our pipeline a long time ago. Shayna just kept calling him. She was so persistent, hitting him. And eventually he said, fine, I'll talk to you guys about selling it. I just refinanced this thing. It's my smallest property, 84 units. I got to fix these elevators. It's going to cost me $300,000. That's why I did this refi, and I'll sell it to you at the end of the year. I'll consider engaging with you about around a sale towards the end of the year. Get on the phone with him, and he's like, yeah, it's also small. It's also far for me. I'm in Chicago. I got a bunch of buildings here, a bunch of different purposes, and I'd hold this till I die. I plan on holding everything I own till I die, but you know what? You've been so delightfully persistent, or your team has, that I'll give it a shot. And he revealed to us over the course of the conversation that he had, I said, how many units do you have? As I pull it up on PropStream, right? And which is not always accurate. I see 61 million in open debt and a lot of free and clear properties. So he probably owns like half a bill. But he said, let's just say more than 5,000 units and less than 10,000 units. Massive portfolio, 75 years old. He's like slurping his oatmeal while he's on the phone. He's just chit-chatting for like an hour, right? He just wanted to talk. And he just wanted to talk about the nature of the business. He was just so interested in it. And he was so interested in working with someone younger who was coming into this space that he could potentially see an opportunity to like help along and mentor. And he even talked about other people who were like our age and in our position that he's come across over the last like 10, 15 years of his career that he's kind of helped like develop into more scalable real estate portfolio owners and not just like business owners that generate a lot of income. The guy was passionate. He didn't give a fuck about the fact that he owned, I don't know, 7,000, 8,000 doors, right? That wasn't really like the topic of discussion. The topic of discussion was investing in real estate and how he does it and the impact on the community and the other people that are doing it and the legacy of it. A lot more fun, so cheers to that than bragging about a couple bucks. Because guess what? You buy the Lambo, you buy the mansion, you get that pretty quick if you make good money. I can have those things right now, Bugatti if I wanted. And then you're done, right? You're kind of done with that shit. And the bragging probably isn't that fun. It probably just like fills a place within you that people feel out of dissatisfaction with themselves in the first place when they go on just to flex all the time. So what's really left, right? It's just more journey. So cheers to the journey. And god damn, that's a lot better than the stuff I drink on the lives in the office. So you guys might see me in like superhero mode on today's live because I wouldn't bring this stuff in. Not that it's like $118 bottle at Costco, right? So it's not too fancy. I got some good notes for you on how to make a bank love you. And I've gone through this process so many times with banks for clients, and I've started to go through it for myself because we've started to want to use more financing instead of just buying cash. And it's delicate, to say the least. It's fickle. The banks are kind of like a deer in the woods, or like for you cat people, cat guys and cat girls. Hopefully we don't have cat people on this live, but if you got cat people on this live, banks are kind of like cats. They're really inconsistent. They're really moody. When you really want something from them, they don't want to give it to you. And when you want nothing from them, they want all the attention from you. They're kind of fucking annoying, to be honest, until you really develop a fine taste or an acquired taste and appreciation for what it is that they have to offer you, right? And it takes a relationship with a bank for it to make sense. And look, guys, this is not the topic of Fannie Mae, Freddie Mac conventional loans. You're capped at 4 or 10 or your DTI. That's not real estate investor talk. That's like, I can get started, but I never plan to scale talk. We're talking about relationships with banks that are gonna lend you their money, not Fannie Mae or Freddie Mac's pseudo government debt that's backed by the Treasury, right? It's their own money that they're giving you out of their portfolio. It's called a portfolio loan, commercial loan if you have it, right? It takes a relationship with a bank or with multiple banks to really get it dialed so that they understand your strategy, your product, and are warm to lending as much as you need for your particular investment strategy that you want to undertake. We're going to break this down to 3 phases today. And I kind of like this sitting down live. How do you guys like this new live at Elliot's house at the Ace headquarters? That's not really Ace headquarters, the Ace mothership, my $235,000 house that I bought in 2012. Let me know what you think about the house live versus the office live. Because I'll do some more on the weekends for you. I'm just trying to figure out the best place to put the chair and the light and all that stuff. We're gonna break this down to 3 phases today. Really, all you gotta worry about with the bank is how to be the appealing borrower, how to bring them an appealing product, which is the asset that they're gonna lend against, right? And then how to deliver an appealing relationship to them. What are their criteria about these 3 subtopics? And each subtopic has a bunch of little micro topics underneath it. If you could think of those like those multi-level lists in like Microsoft Word or Google Docs, right? Where it's like 1, A1, A1.1. There's a bunch of that shit going on in here, right? And I'll try not to make it too wordy so we can do some Q&A. Let's start with the borrower. Let's kick it right off. So look, they're gonna want, 3 things from a borrower. And I'll post this outline afterwards, right? I don't know if I already said that, but I'll post it in a story so you guys can screenshot it. The first thing they want from a borrower is cash flow, right? And some commercial lenders generally call it global cash flow. What they take into consideration is all income sources and all expense sources. That doesn't just mean your house and your car and your student loans, but it also means the debt on your real estate portfolio, your tax bill, a variety of other things, right? So the most important thing about income or about cash flow is income. Obviously, right? And if your expenses are fucked and you're just like a bad money manager, then no amount of income can save you, right? Some people just make more money and they just end up spending more and more and more. And we'll talk about conservatism and overkill and why it's good for banking relationships in a bit. But the number one thing is income. We can assume you can control your expenses, right? They're gonna look at the amount. How much money do you make? It's good to make a lot of money, obviously, right? So I'm not gonna go too far into that. They're gonna look at how long you've been making that kind of money for. Look, if you claimed in 2020, $150,000 in income, but in 2019 you made $60,000, and then in 2018 you made $50,000. They might ask some questions about the nature of your current income and whether it's going to be able to continue to sustain itself at this high level, right? So duration really, really matters. They want to make sure you're not just a flash in the pan. And same with the opposite direction, right? Like if you've got a couple really strong years, 18 and 19, and then 2020, you had a rough year, especially with this COVID thing going on, they're going to be like, what the hell is this? Come back to us when the income's higher again, because now we're worried that you're on a downwards trajectory or that COVID and the changes in the economic environment have impacted your ability to make the kind of income you were in 18 and 19 moving forward. So you're going to have to prove to them otherwise that it was a fluke year. And probably it might take 2 more years afterwards. They want to see that number completely off the books. And lots of banks, by the way, commercial lenders, they ask for 3 years of tax returns, not just 2, unless the most recent year is like fucking nuts, right? Like let's say, you only have 19 and 20. 18 really sucked, so you're not going to give it to them. 19, you made $80,000. 20, you made $700,000. Extreme example, right? They're not really going to be tripping about the fact that you've only got 2 years and the fact that the first year was pretty light, especially if you're not getting a massive loan and pushing your limits. So duration of income matters. The type of income matters too. I had a couple different situations where banks have come to me, especially big banks, big conservative banks, and they go, you're a flipper, we don't really understand your business, maybe we're not really friendly to like real estate investors in particular, we just want general business clients. And we see your income, they're like, hey, you make a lot of money, but you're basically a day trader of properties. So we don't really want to lend to you, or we're going to sensitize the fuck out of your income numbers, which sensitization means they're going to go ahead and add stress to the number, knock it down 30, 40, 50%, knock it down to your lowest year in the last 3 years, whatever they could do, right? To feel like they're being conservative because they don't really like the type of income that's coming in. They see that type of income as a risk for the bank, and a risk towards the borrower's creditworthiness and ability to service their debt, right? So they don't love me. Local banks really, really love me because they understand the local market, the product, and they understand real estate investors and appreciate them. And my income's really high as a real estate investor. They take a look at it and go, this is right up our alley. How much debt can we give you, right? I finished up, I couldn't get a loan through US Bank with my 2019 returns, which were really like strong numbers, right? Because it was COVID, they didn't want to deal with investors and self-employed investors in particular, so I just didn't bother. Went to a local credit union in Kentucky to get a refi. They looked at my numbers, did the refi for $450 quick. I showed them a 72 unit deal immediately after. I said, do you guys have an appetite to lend to me on something like this at 80% LTV? They said, I couldn't see why not. So completely different attitude depending on the bank, right? But the type of income really, really matters. Self-employed, always harder. You gotta have stronger numbers than the person on W-2 and for longer than the person on W-2 to offset the fact that you're seen as a higher risk, right? So everything you'll learn in this banking world can be offset. When the property doesn't cash flow quite enough, as long as it's not a complete dud, you can offset it with income and liquidity, right? If the income is not as strong as they'd like, but the property's a cash cow and your liquidity is good, things pick each other up, right? It's almost like these different components of qualification, to some degree, as long as they're all below a minimum threshold, kind of co-sign for each other, right? And lift your qualification ability. It's kind of like an aggregate score with weighting. As long as nothing critical fails and falls below the minimum check, then you should be good. So type of income matters. Now, the next thing I look at is expense. You won't believe how many people have come to me with a $200,000, $250,000 income. They go to the bank, they get nailed, doesn't qualify. Why? Alimony, excessive car payments, big ass house that they just upgraded into, rental properties that don't cash flow. Expenses are a real thing, and people that don't manage their expenses don't realize that just because they have some cash, maybe in a brokerage account or in an actual checking account, and they've got the income, that the bank actually, like, they don't realize that the bank does care if they're a shitty spender or not, right? They're going to look at debt obligations. That's the first thing they look at, is all your debt obligations. So your home mortgage, your other rental property mortgages, your student loans, your credit card balances that you're carrying, hopefully none if you're smart, and your car payments, things like that, right? And there's other ones obviously along the way. If you're, a real jackass and you just bought a big ass boat and a big ass RV and a big ass house and a Lambo, you're in trouble, dude. The bank's not gonna like you, right? So what you're gonna do is that those things made you poorer than you thought, because they're not just depreciating, they're inhibiting your ability to buy things that make you richer, which is the reason I don't buy stuff like that, because the bank gets to look at me and say, oh wow, this guy's fucking living tight, and all of his money is put aside to make sure he could service this debt and grow his relationship with us, which we'll talk about later in the end. So debt obligations count. If you don't have a mortgage, they will look at your rent, right? They want to look at cost of living, and then they'll apply a factor for cost of living to you that encompasses like food and commodities like gasoline, right? Living expenses. So it's not just let's look at your rent and forget the rest. They do apply some sort of like buffer for standard living expenses. And it varies with every bank, right? They'll do that for family and dependents too. So if, let's say you got a spouse that's not working and a couple kids that are young, they're not working either, they're going to apply on top of your rent your debt obligation for your mortgage. They're going to apply usually a $10,000 to $15,000 cost of living deduction from your income as they're calculating global cash flow per each dependent, right? So if you've got, let's say you and spouse work, right? But you got 3 kids, they're young, they're in school, they don't. They're gonna knock $10,000 off your top line for every single one of those kids, then calculate global cash flow. Taxes get taken off global cash flow, right? So if you're paying a high income tax bill, it gets knocked right off. This is why depreciation deductions are so important, because depreciation deductions don't reduce your income in the bank size, they get added back, but they do reduce your tax liability. So it's like a double whammy for qualification strength. I might show a very a relatively small income. I almost gave you guys a number. A relatively small income compared to what I really make after you depreciated my income down, right? But the bank adds it back, and then my tax bill is half of what it was supposed to be. So they see this tax bill that's like 20% of what my real income was, and they go, okay, this guy's not paying a lot in taxes. That gets added back to the global cash flow equation. Business expenses do too, right? So if you happen to be self-employed, they're gonna say, look, this guy's gonna cover his business before he covers his property if shit really hits the fan, because that's how he makes his money. That's where his livelihood's coming from anyways, right? So if your business has high operating expenses, they're gonna reduce that from your income, naturally. Now, they already have been deducted on your tax return, right? But they might look for cash reserves to offset those things as well, because they wanna see a reserve usually over a certain period of time, or it covers a certain amount of time worth of all your expenses. And let's get right into that too. So the next thing after income and expense, cash flow, global cash flow. Does this person qualify? Usually they want to see a 115 global cash flow, which means your total net income after expenses is 1.15 times all of your expenses and obligations, which includes the new properties debt that you're adding on as well, right? So they want to see a 115 global cash flow. They want to see liquidity too. Do you have cash? Do you have stocks in a stock portfolio that are going to, act as cash if you need them to? And it varies by bank. In the heart of COVID, the bank wanted to see 1 year of liquidity to cover all of those expenses, right? Minus taxes, obviously. 1 year liquidity for an average person like who wants to buy rental property and lives in California, probably $100,000. That's without a ton of expenses, right? Or $70,000-$80,000. So the bank wants to see liquidity. Liquidity is not just cash. It could be stocks in a brokerage account. It's not 401k IRA money, because the bank can't collateralize that, right? Commercial loans cannot take recourse against those retirement assets. They're protected from recourse. So cash, stock brokerage account. And I had this conversation with my banker recently. I'm like, hey, what about cryptocurrency? I don't own any crypto, but a lot of our investors do have positions in crypto. One of my buddies was buying a property from us. He actually has like 2 coins worth of Bitcoin, right? So now it's like $40,000. At the time it was $120,000 or $110,000, something like that. And my banker said he actually adds that to the liquidity equation, treats it just like stocks in a brokerage account. Now, I don't know what the underwriter does to that, if they sensitize crypto to some degree, because I gotta believe like an underwriter looking at like total bubble stock or a bubble coin is gonna sensitize the value of it downwards. But I don't know if the underwriters are into that level of detail or if they know it well enough. Maybe they might treat all of crypto like that, but I have a hard time believing an underwriter is gonna see something like, I don't know, like Ripple, for example, and go, oh, there's some risk in this, or Tesla, and go, oh, there's some downside risk because look how volatile the stock is. But it might vary by the bank. If it's a big investment brokerage that happens to give lending services, I have a hard time believing that they wouldn't sensitize the liquidity in your portfolio to some percentages, like 20% downside potential, 30% downside potential. They might count only 70% of your total brokerage account and liquid assets other than cash towards real liquidity. So that's the beauty of having, by the way, owning stocks. Look, I prefer real estate over stocks strongly. But the nice thing about having a stock portfolio, which I just kind of keep cash in, is I am getting dividends on the stocks that I own. I'm not really a fan of growth stocks in a peak market. They could keep going, and I'm not afraid of leaving money on the table. I don't really give a fuck. But I want cash storage with reliable yield with undervalued assets. And it's, for me, a form of getting a return instead of keeping too much cash in the bank, but it still counts as cash when I go to the bank to qualify for a loan. So I don't have to keep an infinite excess of cash in the bank if I want to qualify for a big property. So have a stock portfolio if you plan to be a big real estate investor, because it does add to your liquidity. Store your money there, or a good chunk of your money there. And the third bit is, outside of cash flow and liquidity, the third bit the banks look for from a borrower is going to be your portfolio. And the long and short of it is, does this perform? My gardener just showed up, so if you guys hear some noise, then that's what it is. Does it perform is going to be the big question. Does it perform? What do you own? Is your LTV maximized too? What are you showing on your Schedule E on these rental properties? If you own them for a couple of years, don't buff the expenses. Pay taxes on that income. Use the depreciation to offset the income, because if you buff those expenses, guess what? You're giving your Schedule E's to your future lender, and they're going to say, hey, you're a shitty real estate investor. You didn't make any money on these things, even before depreciation. So careful for the performance of your portfolio. Careful how you write things things off, and careful for the amount of leverage that you carry on your portfolio, because even if your income and liquidity can support it, they might look at you and go, this guy's a maximum LTV type of guy, and feel a little bit concerned about giving you a loan at maximum LTV. They might go ahead and give you a 70% after they see that, or a higher rate or a shorter term, right, to offset their risk in working with you, because you might seem a little overeager for debt. And before we move on to the asset and the relationships, let's say one last thing about the borrower, okay? And I know this is gonna go long, and I'll answer Q&A, I'll stay long too, and I am gonna save this live. A note on overkill. It helps to be too financially strong. I know people say cash is trash, it's a waste of money in the bank, I make too much money, I don't spend enough of it. Overkill is gonna make your life a lot easier. I call a bank up and I go, hey guys, this much income, this much liquidity, big number. I only want a loan for $350 on this property, and I'll go ahead and put $350 of cash in a bank account with you guys, just to support this purchase and to show you that I want to build a relationship. And they like that overkill. Why? It takes all those other little things that were kind of questionable, because there's always little questions and little concerns and little hesitations that banks have. Right? They're not a big deal, but they'll still ask you, and they could pile up and kind of kill the loan, right? Or the lender's desire to do the deal with you because they don't want to deal with the uphill battle. So you tell that lender, hey, this, and this, but you know what? Here's $1 million, right? That I got in the bank account, just chilling. And they'll go, okay, you know what? That $1 million is going to solve any concerns our underwriter could have. This loan is worth giving it a shot. Boom, easy enough. So overkill counts, guys. It is valuable. Cash is not trash. Cash is not trash. I bought some really, really discounted properties in COVID last year, all the way through the end of the year. Disgustingly discounted properties, all cash, fast, not distressed properties, just sellers that really wanted confidence in a buyer because nobody else could qualify for loans. Commercial lenders didn't want to give them out. There was too much sensitization, right? So who won? The person with cash. So it wasn't really trash because I bought quite a bit of property at a 50%, like as is condition, 50% discount from market value total. So yeah, cash isn't trash. Go to any bank and tell them cash is trash, and they'll just throw your file in the trash along with your cash. Second thing that the bank's gonna look at is the asset, right? The first was the borrower, this is the asset. And we did a video today on debt coverage. The first kind of subcategory here is, does this asset cover its own debt? Annual rents minus all the annual expenses, vacancy, maintenance, utilities, insurance, property management, a cash reserve, what's left? Net operating income, right? Does that net operating income exceed the annual mortgage payment by at least 1.25? And if it's stronger than that, better. If it's lesser than that, well, you're gonna have some problems with approval. And the bank is going to sensitize expenses. So you might send them the seller's expenses or your pro forma expenses if they'll accept that. They'll look at them and go, okay, cool, this is a 1.3 with what the seller says they spent, but the seller's maintenance line item for the last 2 years is really low. So we're going to buff that number up. It was only 5%, we're going to make it 10% to be safe. And the utilities, we don't think it's really that low. So we're going to take the utilities and bump it from 3% to 5%. All of a sudden, your property doesn't meet their debt coverage requirement because they've sensitized the expenses. So what you need to know is how your bank calculates debt coverage from property to property. You also need to understand what can offset unfavorable debt coverage circumstances. It's usually something about the borrower. Hey, it's the overkill factor, right? My income's so high, this thing's a 1.1 debt coverage ratio, but it's super under rented. Here's a study I did on market rents with some comps. I've submitted it along with the loan to you, Mr. Banker. And by the way, I could support it until then. Look how much money I made the last 2 years. I made $1 million a year for the last 2 years. And this mortgage payment's only $2,500 a month. It'll give me a year to get the rents increased. This property will be just fine. They'll probably say, sure, no sweat. So you really need to understand how they calculate debt coverage ratio. You really need to understand how they sensitize the debt coverage ratio and what could possibly offset it. And while you're doing that, think of document submission too, right? They're going to qualify or disqualify the property. Thanks for buying that badge, by the way. It pays for the whiskey. Cheers. I need to drink that more. It's really good. I can't believe I left that last drink in there for so long. Probably because I was saving it for a special occasion like this. But when you submit documents to the bank so they can calculate the property's cash flow, work in their favor, right? Like show the right numbers in the documents. Don't add a vacancy factor on your pro forma if the tenants are ultra long term and they're super under rented like we talked about yesterday. Have the seller lease back that garage from you if they're using it for storage for a 6-month term or a 1-year term and credit it back to them at closing if you fucking have to, right? Get the cash flow looking good. Make it easy for your banker, make it easy for your underwriter. Send them very clean profit and loss statements. If the seller sends you a shitty handwritten P&L, transcribe it over to a printed form with a nice looking professional template, docu-sign it to them so they can sign it, the seller, bring it back, give it to the bank, give them a clean rent roll, give them all the leases at once, give them everything that makes the deal not only look like the numbers are strong, but also it's professionally packaged and operated, right? And I think it's gonna give a good impression to the underwriter. So that's a big note on documentation. Plus the lender doesn't wanna have to go back and forth and educate you on how to prepare these documents, right? They want you to be turnkey. If you can provide them a turnkey loan submission, guess what? They're gonna wanna work with you more. Same with the underwriter. They're gonna feel confident in you because they're gonna say, hey, this person understands what we need to make this a safe bet for us to lend against. And that's gonna get you a loan. There's so much intangible baked into this whole process, guys. The product matters too. It's not just the debt coverage, right? And I've ran into issues with footprint, for example. Banks wanna be near their assets. It's kind of a dated thing because they can hire third parties, but they don't want to be in a different state than the asset, right? They don't want to be 3 hours away. They don't want the nearest branch to be 3 hours away from the asset in some cases. They want to feel like they have some sort of connection with their collateral because that's what's securing their debt. If you don't perform, all they're left with is that property. So the property and where it is and what they could do with it, it matters, right? So footprint matters, the location of the property. The market matters. I've had banks say, yeah, we'll do all over northern Indiana, but I don't like Lake County, Indiana, because our bank got really burned in Lake County in the last crash, right? These banks they're small. They remember, right? Things happen to them. Big banks don't really remember. They don't care. But small banks, they remember. They might say, we don't like Racine, Wisconsin, and East Chicago and Gary, Indiana. We know the markets perform better now. We understand that. But you know what? The credit department just doesn't have an appetite for it because we had a lot of people default in it last time when there was a big crash, because we gave out loans on properties that weren't really stable when we shouldn't have given those loans out in the first place. And they're gonna be kind of cautious about it, right? So they may not like the market. They may not like the asset itself. I was buying a 20 unit in South Bend at some point, and it was a previously converted retirement home, single story 18 studio units. It was converted to an 18-unit building in like 2007. So basically brand new, like gutted out, built out, all that stuff. And it was odd because it was in a nice area, really close to Notre Dame, but like just far enough outside of the residential area. It was near a bunch of big office buildings and a hospital. It was a little bit non-conforming, even though it was actually a good building and we wouldn't have a problem renting it out. They told me straight up, this was the word they used. Hey, our credit department doesn't like the collateral. We don't dislike the situation, we don't dislike the financials, we don't dislike the condition of the property, but we just don't like the collateral. Meaning that they didn't want to be stuck with that property if I defaulted. It was just weird, they wouldn't know what to do with it. I would know what to do with it. I'm a fucking professional real estate investor. They're not at all. They want something more conforming, right? So they didn't like the collateral, and I completely understood. Now, what did they do? They came back and said, because we don't like the collateral, we're gonna lend to you with 70% LTV instead of 80 or 75, and we're gonna want a 20-year term and not a 25-year term. And I didn't give a shit. I got out of the deal for a completely different reason. But the asset itself does matter. The type of property, some of them don't like storefront right now, or retail in certain markets, right? Understandably so. Some of them don't like office in certain markets, understandably so. So they're gonna care about the type of asset that it is. The condition might matter. Especially if you send like an appraiser out and then they get in and the appraiser leaves like all these notes on like what's wrong with the property and how it's not serviceable or how its lifespan may be shortened. Well, that's gonna all get passed on to underwriting, and they're gonna look at that and say, we don't wanna really lend on an asset with a shortened lifespan or with questionable condition. So we'll give you 50% LTV, or we'll give you a 15-year loan because that's what we think the lifespan will be before it needs significant CapEx or without significant CapEx. The condition of the property could matter if for some reason it raises a red flag. Usually they don't even look at it, right? The valuation matters. Obviously it has to come in at the right number. If a property doesn't appraise for what you're purchasing it for, then they're gonna give you a loan for whatever LTV of that appraised value. If the property's being bought for $1 million, it appraises at 500, and they want to give you 70% LTV on $1 million, you're not getting a $700,000 loan. You're getting a $350,000 loan now. So valuation matters. The size obviously matters and the price matters. Look, a big piece of this banking thing is who wants to do the work for you? Which lender is going to want to do the work for you for all this? And a duplex or a single family home or $100,000 deal is not going to excite any of these commercial lenders or banks, especially if it's the first time around with them. Like, you might have to build that relationship first, show them that you're not a waste of time, and then throw in some little stuff, and then throw them in packages too, so that they're at least, they know they're going to do 5 little properties worth of work, but they're getting a $500,000 lump sum or $1 million lump sum or whatever it is, right? So size and price of the asset does definitely matter. Some say we won't do less than 5 units. Now, they will once you actually start working with them. There's no rule whether commercial lenders can do a 1 to 2 to 3 to 4 unit building or not, or what price they can do or not. In most bank situations, they could do smaller assets, except for like big Wells Fargo, Chase Bank types. They just won't tell you that because they don't want to waste their time on you. And outside of the product, guys, I mean, we talked about the asset itself. Let's move on to the relationship. This is the piece that's really between the lines, right? There are 2 words that describe really the 2 things banks want. It's a 2-word phrase, but it actually tells you the exact 2 things the bank wants from their relationship with you. Easy, money. That's it. They want it to be easy and they want to make money. And they want it to be easy money. So give them that. Give them easy money. Understand what it takes for them to make that easy money and provide it to them so that they want to work with you. Look, we have clients that come to us all the time to buy investment property. It's kind of funny how this relationship thing with the bank works, because as we've learned how to navigate banking relationships and give them what they want, we realize that the bank actually wants from their clients exactly what we want from our clients. They want to give you a favorable product that makes you money, but they want you to be easy and they want you to make them money too. And that's it. That's it. So we do that for our clients also. They come in, if they're difficult, just let me know if it's really loud out there, but I don't think it will be. The clients come to us. The ones that are difficult, they don't get properties. The ones that try to haggle us, they don't get properties. The ones that are easy to work with, understand their criteria, come prepared to make decisions, well qualified to work with us, are willing to maybe buy cash and refi or close on tight timelines, those people get deals that make them money. And they make us money too, and it's not too much work, and that's how they get selected in an environment where, well, as soon as you kind of get up in like the niche financial world, not that we're really up, right? But as soon as you start to climb that ladder, things get very handshake. Very, very handshake. It's all about who you want to get into bed with, right? Because everyone's got money. Like, you get into this world and you realize, at first you think there's a money shortage. Then you realize that there's a shortage of the right type of product and the right type of person. And when you find them, you cherish them, but there's no shortage of money out there at all. So make it easy for the banks. You want to be in their footprint, right? For some reason they care. Sometimes they don't. Sometimes you could be an out-of-state borrower that's not anywhere near a People's Bank in Indiana, for example. They're friendly towards that in exchange for something else. Maybe they want you to be really strong. That's the overkill thing. Maybe they want you to make a big deposit in an account. Maybe they want you to only buy bigger properties, at least at first. Maybe they want you to open up business lines of credit and credit cards with them and operate your business with them. Give them all that stuff if they're willing to work with you, but footprint does matter. And even for the ones that will accept someone out of footprint, they're always going to be hesitant. So you want to offset that with something. The next thing is your temperament. Look, you can't be an asshole. You can't make them work too hard. You can't, send them the wrong deals all the time. You can't refuse to understand their process. You have to have a good temperament and be willing to also kind of compromise. You can't nitpick and haggle every last fucking dime with them. You can't refuse to do what they need from you. There are a lot of people that, this is kind of self-evident, right? Like, you guys are watching this video and you're like, yeah, duh, don't be an asshole. There's a lot of assholes out there. And there are a lot of people that, they're not just assholes, they're scared, they're fearful, and they don't seem confident in what they're getting into. And who wants to work with that person? That seems like the person that'll kind of leave you at the altar, whether it's for a loan, for an investment deal, whatever. I mean, imagine you're going to, let's say you're going to get married, right? You get up to the altar and you feel like the person hasn't really been confident this whole time. You're not going to want to marry them. The next bit's your deals. They want good deals. They want strong deals. They want deals that are priced reasonably and that don't have problems with appraisal. They want deals that cash flow well. They want deals with good documentation, that are in good condition, that fit their appetite, right? So bring them good deals and the banks will love you. Bring them shitty deals that are an uphill battle for your underwriter, that have a low likelihood of approval, so there's a high likelihood of them wasting their time on you, and they're not teed up well, so there are a lot of work to get through. then the bank's not gonna wanna work with you. So bring them easy deals, bring them good financial behaviors. You won't believe how many personal questions you can grow a mean beard. I sure can, because I cut it every week and it grows back every week. I just cut it yesterday. Look, your personal financial habits matter to a bank. They ask personal questions. I sent all my documents to that Kentucky bank for that refi earlier this year. God damn, I need to buy more of this. I was strong. It was an overkill situation. We talked about overkill. I overkilled it. I went, hey, here's how much cash I'm holding. I know it's probably stupid that I have this much cash, but I have this much cash and I have this much income, and I only want a loan for 50% of this property's appraised value. That's all I asked for, not even 70, 80. So I overkilled it, gave them every reason to approve me. You know what question I got back from underwriting? The one question I got back from underwriting, I can show you guys the email, it's kind of hilarious. They responded to my lender who passed it along to me. Real estate investors usually have a lot of debt. Can you please have Mr. El Khoury and Mr. Verga explain to us why they're not carrying so much debt and why they're keeping so much cash? It seems uncharacteristic for the type of business that they're in. They literally said, why are you guys so financially strong? What are your habits? And then they said, what are your plans? What's your business plan? Do they plan to now, have they just not gotten debt? Now they plan to maximize? Or are they just going to keep doing what they're doing here, asking for 50% LTV? They were kind of worried we were like baiting them in with an easy loan just so we can go back and get all this other debt later on top of it, right? They wanted to understand what we were going to do with our money and with the bank's money for years to come. And that explanation is going to be key to the bank, these small banks who remember you, wanting to work with you. Funny story, this bank saw a TikTok I made about the financing story that included them in that TikTok. I didn't include personal names, just the picture of a branch on Google Maps, right? And they were like, some of them were kind of worried. Other ones were psyched. The sales manager was kind of pumped up. He's like, oh shit, this guy made a video on us. Who is this guy? And then my lender's like, oh, it's this person I'm working with. And guess what? You got a little bit of credibility. These little banks, they know you, right? They know you, they understand you, they want to understand you, they want to know your situation, and they want the relationship because that's where the easy money is. So your financial behaviors are big. Look, even if your income can support it, if you've got 5 Lambos on your personal financial statement with big loans, they're going to be like, this guy's kind of got the potential to be an idiot. Or if his income goes the other direction, is he going to be able to sacrifice on his lifestyle to be able to continue to support this debt? Because it doesn't look like it. This person's got 5 Lambos. Hey, they were living in $1 million house, they sold it, and they upgraded to a $2.5 million house. Is this the kind of borrower we want to work with? Would we rather work with a borrower that is going to give us that $2.5 million acquisition on an income generating asset instead? Did they only put 5% down on their house? Even if you've got the money for it to qualify, they're going to look at you and go, what is this person like with their money and with our money, right? I mean, because imagine if you're not really smart with your money and it's apparent to the bank, what would motivate you to be intelligent with their money is what they're thinking. You don't even care about their money as much as you care about your own, right? So why would you be intelligent with their money? That's exactly what they're worried about when they look at your financial behaviors. Don't be a dumbass with your money. Send them the TikTok I made about being a cheap ass and washing my chucks for every week for 2 years, or every month for 2 years, and they'll probably love you. And the next thing is your financial strength. We already touched on this a million times. This is all I'm going to say. Look, focus on your income, focus on your liquidity. If you got financial strength, everyone's going to want to work with you. The investor comes to me, 2 investors come to me. They both have $100,000, right? Each one wants to buy a $100,000 property from me. 2 investors come to me. They both have $100 to invest in a $100,000 property. They want to buy it cash, but one of them has $120 in the bank. The other one has $1 million in the bank. Who am I going to want to work with? The person that's got the $1 million, not just because they could buy more from me, but because that person is less likely to shit their pants if one little thing goes wrong with the property. Because they've got another $900,000. They're not going to give a shit if they have to spend $1,000 or $2,000 on a surprise out of pocket. Chalk it up as tuition and move on to the next deal. It's how they're going to think. But the person with the 120 that's going to let go of 100 of it, they've only got 20,000 left, right? And you've got your back against a wall under those conditions. And I don't want to work with someone that's got their back against a wall. I want to work with someone that's just chilling, like just relaxed as all hell, and they just want to empty their pockets is what they're thinking about. Because you know what? That's a lot of people's attitude right now, is they're having a hard time emptying their pockets. I'm having a hard time emptying my pockets. And people want to work with you. If you've got spare cash and don't care. If your problem is actually spending it and not conserving it, then you're probably going to be a good client for someone in the investment space. And look, a couple other things the banks want. Offer these things to them on the front end. Make it very clear you want to offer these things to them. Deposits in an account. I think you guys saw my story. A lot of you on live probably watch my stories, but I got on a call with People's Bank in Indiana a week and a half ago. And I wanted to get a loan on this 5-plex that I'm buying. Just 'cause I'm sick of buying shit cash, man. I didn't want to drop $350 cash on this thing. And I got back with them. They wanted to work with me because I was strong enough, even though they're a little lukewarm about out-of-state borrowers. But she came back to me and offered me a 4% interest rate, a 4 1/8 or something like that. I wanted a 3.5, but I settled for 3.625. They offered me a 4 1/8. They wanted to give me a 20-year loan. Their rationale was because I'm an out-of-state borrower. And by the way, I asked for 75% debt on a property that I'm buying for $350 that's worth $550 as it stands. At the very lowest, $500, right? So I'm going 50% LTV on this thing, if not even lower than that. They should be willing to give me 75% on a 25-year, like no sweat. And I didn't say anything about the 75%. I didn't ask for 80. I'm like, cool, whatever. Here, take cash. I got extra cash. Was my attitude with them. But she gave me a lower loan term and a higher interest rate. And I said, you know what? Just get me approval on this more competitive set of terms, please. She said she's not sure if she can get that done. I said, you know what? Go ahead and give me your operations manager for the bank. I'm going to open an account. I'm going to deposit $200,000 in that account right off the bat, right? And then if we're continuing to do business, I'll deposit another $200,000 in the account too. So we can have an operating account where we can continue to buy, continue to finance deals with you. Her attitude completely changed. Why? Because those deposits are valuable to him, and she probably gets credit for bringing my deposits to the bank too. So the difference in spread that she and her sales manager are losing, which they get paid for as well, is being compensated for by these deposits that I offered them in this big operating account, right? And I know that it works like that. I have not yet, but I will offer them to sign me up for a credit card. They love doing stuff like that. I will go to them for other loan products if I need them. Lines of credit, if I ever end up needing construction loans out there or stuff like that, I'll go through them for that as well. And the other thing, the reason our clients get such a plug with US Bank, and I don't use them, but our clients do, they get super low rates, literally like 275 on commercial loans at 80% LTV, and it's only through me. You are not calling US Bank and getting a 275 with 80% LTV, no origination on a $120,000 property. They'll tell you 250 and above minimum, and they'll give you like a 375 with 80% LTV with half a point or something like that. We've got all that shit dialed in. Why? Because our business development guy does not have to make cold calls because of us. Because I understand, over years, we've talked to build a relationship, and I've realized that this man has to make a certain number of appointments per day. It's a sub-metric, right? So like back when I was a salesman, I was an account executive for a software company. I had to hit a certain revenue, but I also had to have a certain number of demos completed every month, every week, every day. You get tracked along the course of the month, right? He does too. He has to have completed appointments every day in addition to the revenue, the quarterly revenue requirement. So we send him 2 investors every single day, new investors for him. So he doesn't have to cold call. He doesn't have to prospect. He's a sales guy that does not have to prospect, if you can fucking imagine that. All because we're sending him people every day. So he hits his metrics with no effort. It's all teed up for him. And in exchange, he goes, hey guys, I'll drop to the lowest rate for your clients. And I'll do the smallest deal for your clients. Why? Because I'm taking this work that he has to do, calling on new clients, calling for credit card sales, shit he knows he doesn't want to do that his boss would make him if he wasn't already keeping his books full. I'm taking that effort he'd have to put into that and saying, hey, just put that effort into my smaller deals instead. That make you more money, they make me money too. So figure out what these are people with jobs, right? And they have personal drivers. Every person in this kind of scheme, in this bank, understand what their personal drivers are and tap into them. Give them what they want. Make their lives easier. This guy gets to, dude, my banker could sit on his fucking couch in his basement in Indiana where he lives, outside of Chicago, in his boxers with some crew socks and a Fruit of the Loom wife beater on, and play PS5 all day and take 2 30-minute calls and process some loans, make sure the relationship managers are processing the loans right. And that's all he has to do to get paid, while the next guy's making all his credit card calls. That's worth something. So that's the end of my banking spiel, guys. That's how you build a relationship with the bank. You got to tap that magic button and make it easy for them, make them want to work with you, and just have a lot of money. Have a lot of money. Hit me with some questions. I'm going to take a breather and have this whiskey. I'm kind of sweating here. I probably need to turn, oh shit, I was going to turn the Nest up for my phone, but my phone's right here. But the lighting is kind of better in here than in my office, right? Like a lot better in here than my office. Better backdrop too. Let's do some Q&A. You guys love this live, huh? It was super like blueprint educational. I really hope a lot of people watch it over the weekend. I hope a lot of people jump on here and pick up some financial tools from us, shameless plug, because over the weekend they'll be able to go ahead and start plugging in property numbers and realize that once they have the right tools in place, sending over a nice sheet to your banker with each sample property is probably going to make them pretty happy instead of saying, here's the deal, here's the rents, where they're going to hate you. But yeah, maybe that'll motivate some of you guys to actually pick up the analysis guides because you can use them to actually make bank deals easier to submit. I'm going to say this live for sure. People's Bank does not operate in Evansville, but if you want a bank in Evansville, I like Old National Bank. Now, 5 units and above only for commercial loans, but they're pretty inexpensive. They quoted me at 362, 25 a year, 80% LTV, and their headquarters are in Evansville, but their footprint ranges from Kentucky to Indiana to Michigan to Wisconsin. They don't really like Illinois so much, and I understand why. So why put $250 into the bank account if that's just what you're going to borrow? Can't you just use your own money? Here's the thing. You don't want to have zero investable dollars in your account. You want to have reserves to cover the money that you're getting from the bank under worst case circumstances. They all calculate that, right? So there's a value to having reserves. And also, I plan to use that $250 on more properties with them and then refill it with the profits from those properties and keep on rolling and rolling and rolling, right? But yeah, they want to see your deposits. I believe in keeping reserves. I have a very high amount of reserves. It's got a couple commas attached to it and not barely. And that's because I want to have opportunity funds available for really good deals. And I want to have extreme qualification ability available. I promise you, this is a thing for banks. No one on social media talks about it because they go, cash is trash, buy Bitcoin, buy properties, buy stocks, buy my course. It's all bullshit, guys. You go talk to real people in the industry that have really played the game, and they'll tell you that cash isn't trash. It has a value. And when things come crashing down, good luck getting a loan if you're the person that was cash is trash before, whose assets have, by the way, plummeted in value if the market does get soft. You have far less liquidity than the next guy. Bank's not going to want to work with you, especially because when the economy is bad, so the Treasury imposes, or maybe it's the Federal Reserve, I don't know the difference between the two, I'm not a fucking economist, but the government imposes asset caps on banks. They actually perform constant stress tests on banks. They happened during COVID, right? Banks were required to meet a certain amount, they're governed. Banks are required to meet a certain amount of reserves that they have, cash or cash equivalents that they carry to be able to lend out more money. And also their portfolios are assessed for their performance and their risk as well. When shit gets bad, the government imposes a higher level of sensitization. We already talked about how the banks impose sensitization upon borrowers when shit gets bad. That's because it's being imposed on them by these regulatory organizations. So they're just passing it along. So when there's sensitization placed on the bank, they don't want to give out as much debt, or they only want to give it to really, really, really strong people so they can justify having this debt when there are bank audits, right? Banks get audited on a regular basis by third-party outside organizations, which means that you, the cash is trash borrower with a big Bitcoin portfolio that lost half its value, or Dogecoin or whatever the fuck. I'm not trashing any crypto. I just use it as an example because people get so speculative, and has no actual liquidity compared to what you used to, or very little cash. The bank's going to just pass right by you because they're scared of getting audited and being forced to cut the amount of loans they can give in the future and cut their dividends like Wells Fargo had to during COVID. They had to cut their dividend by 75%, which makes the stock price crash, which makes the market capitalization of their company drop dramatically. I think I told you guys in the last live about a bunch of Wells Fargo shares when it was like 21 bucks a share, 20 bucks a share, something like that. Because they had to cut their dividend because they didn't responsibly manage their portfolio and there was an asset cap on them. So yeah, that's why cash is not trash. Big opportunities, the most qualified get them. The most qualified. Because like I said, I go for the person that can afford the $100,000 property, but they have $1 million. Same with the sellers of these properties when things are bad, same with the banks. If they have to pick between you and a person that has 10 times more money than you, even if you guys can both afford the property, they're picking the person with 10 times more money. Is there a catalog of all my lives? There sure is. It's the IGTV tab of my Instagram page. That's about it. There's a lot of them in there. There's got to be like 50, 60, 70 hours worth of these live sessions that are so educational. I keep thinking like, should I delete some of these because it shouldn't be free? And I'm not gonna. I don't think I'm gonna. Just enjoy them. Go take some notes. They're really useful. Rebalancing leverage in properties recommended. I think it depends on where you are and where your balance was in the first place, right? I mean, like I like to keep my portfolio at. Right now, my portfolio is at like 13 or 12% LTV. It's too low. I think it should be at 50 to 60% LTV in a perfect world, but I've got extra cash I don't need. I'm not really going to delete them. I'm just kidding, guys. But I'm glad to see that they're useful to you. I'd say, if you're generating cash at a rapid pace, then you don't need max LTV. If you want to be able to take advantage of opportunities in high volume, like look, if the market crashes, you just want to buy one more property or two more properties, then I don't think you have to worry about like rebalancing your portfolio. As long as you've got liquidity to support, income to support, you might be fine, right? Liquidity could be in the form of stocks, but remember, stocks lose value faster than cash than the dollar does when the economy tanks, even if there was hyperinflation. I mean, you've seen the stock market, what happened to it last year, right? Dollar lost couple percentage points of value, same amount that it always does every year, a little bit more, like a tiny bit more. And then the stock market lost like 40% of its value in like 3 weeks. So your liquidity will be impacted for sure. If you're the person that wants to buy, I want to buy thousands of units over the course of the next decade, 15 years, 20 years, right? Whatever, as fast as I can fucking do it. So I'm thinking about this a lot more. I don't want to impose my strategies upon like a more consumer or retail investor because they might not be as necessary, but do consider them if you do want to scale. Let's see, man, you were rocking that mustache in those old videos. I had a experimental stash just for laughs, and it ended up going longer than I wanted it to because so many people talk shit to me about it that I just kind of rubbed it in their face. I kept this, it was really ugly. It was kind of hilarious. Connecticut, a good market. I don't know it. If you could find a property that's like a 7 to 10 cap, if you could, I don't think it's a landlord-friendly environment out there, but 7 to 10 cap with some rent growth and a quality neighborhood, like B neighborhood and above. I wouldn't play with C neighborhoods if it's not landlord-friendly, but B neighborhood and above, so that you can acquire a stable tenant and you don't rely on like the laws being hella in your favor. That I would consider Connecticut, but I mean, I haven't bothered with it. Where did I gain all this knowledge from? It is experience for sure. I mean, I learned, and I'm not gonna lie to you guys. I've got a really good memory. If I could pat myself on the shoulder for that one, but it's because I was like pushed really hard academically as a kid, like very foreign parents, right? So I had to learn to like just soak information in and not really memorize it, but like integrate it into like a network of other like pieces of knowledge that I already have. Just as a tool to be able to remember them more effectively. And that made it easy for me to pick stuff up when I got into real estate. So very much like hear it once and know it, but years of work and studying this stuff. And then I got really sick of just learning. So I just dove in. It's because I just hated my job. I didn't hate my job. I hated that my job put a ceiling on me. How about that? I liked what I did for work before this. Every job I've done for work, I've really liked, or else I just quit it within like a month. Which I've done that many times too. I probably had like 15 or 20 jobs in the short period of time that I was an employee from 16 to 27 in my life. But the information was gained mostly from experience. The only way to get it from experience is to stop just fucking learning all the time and just get in and do with risk management strategy that's effective so that you don't have the likelihood of fucking up. Those mistakes are tuition, but you don't want to pay a high tuition. You want to pay a really cheap tuition when you're learning, right? How can you invest with us? Requirements are really tight these days. I'm not gonna lie. Minimum 150K of liquidity. Intention to invest 100,000 of that over the course of some period of time, right? Not instantly at once. And that's just because the investor list is pretty big, and we just need to keep it tight. We don't have room for a bunch more offers. We get too many offers on every property. We sent a pack of 5 properties out yesterday, cash only. There was a $400,000 eightplex in there, $375,000 eightplex in there. And we ended up getting like 30 cash offers on each property over the course of like not even 24 hours. So we do have to keep the list tight. That's why I make this, and if you want to get on the investor list, the link is in the bio. We don't do like one-on-one until you've actually gotten on and seen some properties, so we can spend time with our investors and not have to push it all out to a lot of the new clients that aren't ready yet. But the reason I make these videos and all this content, besides trying to draw investors, besides selling some digital products and making some pretty good money off that, I'm not going to lie to you guys, right? But they're cheap and accessible. I think that's why we make good money off them. Is to be able to teach everyone else that isn't on our investor list how they could be an investor. Like the whole goal of this business was to create accessibility in the world of investing in real estate. Accessibility and high quality investments or performing investments that actually are favorable for you guys in a market where it's hard to find a favorable investment. It's been hard to find a good investment for like 5 years now, right? So anyone can invest in real estate was like the motto on our first old little Squarespace website. It's still the motto, and if you can't get on our investor list, just go watch these lives, go watch these IGTV sessions, and they'll show you everything from how to do due diligence to how to actually like find deals off market. I'm not going to tell you guys how to run an acquisitions business like me because no one's really going to do it. Very few people are actually trying to chase that goal. They're just trying to invest in some real estate. But property management, we're talking about banking here, trying to give you the whole toolbox. That I wasn't able to get until I actually went and did this for 12 hours a day for 5 years straight. So hopefully you can pick it up in 100 hours and not 10,000 hours like me or 20,000 hours. How much money do my investors ROI? Well, it depends on the property, right? I mean, our properties are 7 to 10 caps. They get super cheap bank rates through us because we've got that plug that I told you about. So a 10 cap at like, a 2.75 interest rate is like a 28-29% cash on cash return. But I always tell investors, like, don't worry so much about the cash flow, especially in earlier years where you're going to have more like incidentals occurring. We consider that big cash flow margin a margin of safety for our investor, and we still have strong fundamentals for rent growth, right? So these aren't cash flow only assets, although we don't bet on appreciation. We definitely feel like the fundamentals for stable growth of property value is there in our assets. And actually our markets have out appreciated like California markets in the years that we've been in them, but we didn't mean for them to, right? We just saw the fundamentals. But I say, that 27% cash flow or 20 or 15, depending on the cap rate, is not as important as the accumulation of, and I made a live on this, cash flow, principal reduction, appreciation, leveraged, right? Tax benefits, and then rent growth, which really makes your property cash flow in 10 years from now. Those are the things that we're really looking to maximize. So every single one of them is paid attention to when we select markets and products and management companies for and financing relationships for our investors. You get a 12% annual return on investment just by paying off your debt, even if you break even, without appreciation, without tax benefits, on a 2.75 interest rate. But on a 3.75 interest rate, it's like a 7% return or an 8% return, right? So our investors right off the bat through our banking relationship make a 4% higher return on investment just by breaking even and paying off their debt every month. They're having their tenants pay off their debt every month. So it's the little things, right? It's a game of inches and it all piles up. And we're trying to focus on how to pile everything on there and add a good experience to it. So I can explain running an acquisitions business, and I have. I've talked about sales, I've talked about growth and scalability, but it wouldn't be a one hour live. Like if you guys think the amount of like real estate thought that goes into the content on this platform is heavy, or the amount of real estate knowledge that we've had to acquire is heavy, it's actually like overshadowed strongly by the amount of business strategy, tactics, philosophy, and operations that went into creating this. Those far exceed the magnitude and volume of information and effort and thought that goes into this business when compared to the relatively small amount of real estate thought that goes into this thing. And it's fun, as you guys can tell, I'm passionate about it. Then you could double your net worth in 1 year, try to wholesale in California. You know what? My net worth's it's moving pretty fast, man. It's to the point that someone asked me earlier in this live what it was, and I didn't know if the number is accurate because I think I gave him like 6 months ago's number, and it's probably doing a lot better than that. Am I a private money lender? No, we're keeping cash for our own operations. We have a lot of opportunity to use it for, so I don't think it would make sense for us to start a different business just to make a similar or lesser return than what our current business model is doing for us, and adding that operational burden. Is creating a title company profitable? It can be, but it's a volume business, right? I mean, what does a search and exam cost and a closing fee? Like between the two of them, like $800-900, and I'm sure they take a commission on the title insurance policy too. So per closing, they maybe make $1,500, something like that. $1,200 less, I don't know. I mean, smaller deals, right? They can make less. So yeah, I mean, it's a volume business. You got to keep busy and you got to be operationally really efficient. I got to imagine. I don't own one. I wouldn't own one personally. I don't like businesses that rely on volume with low margins, zero interest, especially with like very operations heavy income generation strategy. I bet you my deal calculator sales like make more money than a lot of title companies do, without me having to do anything but post on this Instagram and kind of engage with you guys, right? So I like scalable businesses. I like when the internet gets involved. I don't like service businesses that don't have big ticket items or services attached to them. Do I use an S-Corp and pay distributions? Absolutely. I W-2 myself, and then we just take distributions for whatever extra money we want, which is not much. $6,000 a month is all we take total over the course of the year. It's tax-free $6,000 a month, but it's been $6,000 a month for like 5 years now. I think we started at 5 for like the first 6 months, then we upped it to 6, maybe first 8 or 9 months. Upped it to 6. Haven't taken more than $6,000 a month since. Occasionally, we want to buy something, we'll take an extra distribution. But yeah, that's it. Ricardo, have you ever thought of remote investment outside of the US? I haven't, just because like the world's still our oyster, right? Or the US is still our oyster per se. There's probably a market for it, but like, if I were to be like hyperbolic, I would say that investing outside of the US as like an alternate business is almost like me starting a private money business or manufacturing phone cases or so. It's just different than what we're doing, right? So it doesn't really fit into like our model of like verticals, like our network of businesses. And we've got a couple ideas that really do fit into our network of businesses. More education on social media. We've got a big vision marketplace idea for property sales that I'm not going to go any further into, but it is a big vision, industry disruptor, kind of like world breaker idea, right? That piggybacks on our current process infrastructure very nicely, right? We just need software engineers. And luckily we don't need venture capital because we have cash. Guess what? So we don't have to deal with fucking people taking our equity, which is why cash is king. So a lot of ideas that fit better into the business model. Investing in a different country, probably not like appealing enough, doesn't scale the profits any more rapidly than our current business model's profit scale also. So not a big thing. Can I mentor you? Not doing mentorship now. I probably will start doing like giveaway 30-minute calls once a month, maybe randomized or something like that. Maybe they'll be recorded. We can put it up for everyone. Maybe they're not. Maybe I'll just do a free call for everyone. But I'd like to put it up as content actually. So that might be it. How is it tax-free 6K? I'm not really sure what you're asking. Maybe you're asking somebody else a question in the audience. Best way to find property management. I made a whole IGTV video. It was actually a live session like 3 or 4 weeks ago on this. So just hop on. It's like 30 minutes long on how to find property management. And I'll do a couple more questions. Could I explain what my software engineer does in Python in more depth? They scrub county records for public data. I couldn't tell you the process because it's different for every set of county records. You've got to go learn how these online county databases work. And then you got to give basically like instructions for your engineer to develop that crawler. It's not that complicated. And sometimes you have limitations, right? Like you have limitations based on the way these county websites are developed. So yeah, that's what we do there. And then I do a lot of interpretation of the data that comes out, which is really where the money's at, to make sure that we're chasing after the right properties. But yeah, that's how we get that data. Jason, nice to see you too. Do you have a cigar? You probably have a whiskey in the stove right now. 30 minutes free 30-minute sessions will be fun. Do I need a new accountant? I think I have a new accountant. He's a client of mine too. How do you feel about no doc loans as a way of getting started? As a student, I ain't got steady income, but I have nice credit. Worth it or not? No. I mean, what's your problem? Like, you don't have money, right? Invest that same level of effort you would into a property that's not going to make you a lot of profit into going and making some money in some business. Go do some like fucking Airbnb arbitrage or some shit like that, right? Like, I don't know. I'm not saying go do that model. Go create revenue. You need revenue. When you have revenue, when you have a money problem, that's when you invest. Investing is not for people that don't have I have too much money, I have extra money problem. Or it shouldn't be, right? That's a really, really slow, painful, and like unfulfilling way to invest, especially if you're going to be active and involved in your brain, right? Like if you're going to invest without a lot of cash, without a high income, without a lot of cash to allocate every year, then go stick in like an index fund and just do the dollar cost average thing. Would be really, really passive, right? Because the work should be traded for a higher reward, but the work often isn't traded for a higher reward unless you have a lot of resources or more substrate to kind of put into that equation, right? So I would say go make some money. You're young, you're in college. Go find that 7-figure a year idea. And when you do, guess what? It becomes really fucking easy to invest because you have too much cash. You're like, oh shit, okay, let me just pour it into this property and this one and go to this bank and just get these easy loans. And then you won't be thinking about having no doc loans or 95% LTV. You'll be going and chasing after 50% LTV because that's all you'll need to buy the next deal. You want to be in that situation. Create that situation if you're young and you have the desire to. When am I going to start sending self-storage deals? I got to find them first. And what you guys don't see behind the scenes is that we have a fucking painfully high standard for what our clients see. A painfully high standard to the point that like me and Mike argue, right, over it. We're always on the same page, but we have like these disagreements about these properties that like, feel like they may or may not be our standard for what we should sell to our investors, even if they're profitable to us. So we leave money on the table. My dog just like woke up from a dream and like hit his head on a stool a little bit. We'll get into it about like, this property's got a good spread and it's a good deal dollars-wise to the client, but is this like the experience we want to provide? Are we prepared enough to sell this? Do we have the resources and the team in this market to be able to sell this? That's a real problem. That's a real problem. So if I were to go throw you a self-storage deal or put you on a self-storage deal with me as an operator or a sponsor of the deal where I'm like obligated to represent your best interest and the financial performance of the property is supposed to be able to put this preferred return in your pocket, I'm not going to do it if I'm not going to do it really well. So that's why self-storage is not on the list yet. We got to get into that business and understand it better. What data do I extract from county websites? Seller data, where they live, what they own, so I can send them shit if they own the stuff that I like. I've got 4 full-time employees and then myself and my business partner, which are also we're full-time employees, so I suppose 6. We are big advocates of small operational footprint, revenue growth. Don't grow the operation, grow the actual revenue as much as possible without having to grow the operation until it gets to the point where the operation growth would grow the revenue at a much faster pace. Keeps you small, keeps you lean, keeps you really profitable. If I could humble brag a little bit, our margin of profit for 2020 was 86% of our actual revenue collected. 14% was expense, and it's kind of nice. It's kind of nice. No, David, you can't be an intern. You're too grumpy. Cost segregation always, yeah, like on a $25,000 fucking house. Cost segregation. I need the tax bennies, and I get them done for $400. And if you buy multiple properties that are like similar or identical to each other, you can use that KBKG cost segregation study for one property, but it would apply to both just because they have the same characteristics, right? Which is nice. I bought 2 sister 6-plexes in Kentucky, and I did one $400 cost seg study, and I believe the cost savings on both of them, so I got like a $57,000 bonus depreciation plus straight line depreciation of 3.6% of $475, so another like $12,000. That property saved me by itself like $36,000 in taxes, or $40,000 in taxes first year, something along the lines of that. Pretty nice. KBKG is the cost segregation site. Would I consider streaming on YouTube simultaneously? I gotta learn how to get that dialed without another device. Someone sent me like a repost.io or something like that that I need to figure out so I could do that. I just like the interface of this a lot more. I need to just download this and then put it on YouTube. But I mean, I do want to like take all this content and push it to YouTube because there's a value to having it on both platforms, and also I'll make some money. But YouTube's optimization scheme is a little bit different, so I'd have to like put some work in to learn how to optimize the posting of the videos to be able to get organic traffic. And then I'd probably stick some ad dollars on it, like $100 a day or something like that, just to get people pushed into the platform. How did I start? So I got a whole live on this thing, but if I could just give you a quick summary. Really cheap kid, immigrant kid, didn't have money, family didn't have money, scrappy as fuck, parents pushed me really hard to be good at stuff. Dad always told me not to follow anybody's rules if it didn't make sense to me. All my life, like put it in my brain. Got out of college, had cash saved up because I worked through it, got through college basically for free, very little tuition to pay, no student loans. Bought a house in the crash when I was 23 years old. Lucky deal. I'm sitting in the house right now, right? It's a 3-2, 1,800 square footer in Sacramento, California. About B- neighborhood. It's probably worth about like $525, $550. I got it for $235. I put $50K down. Knew I was losing a contract job shortly after I started the job. I got the house. Moved my buddies and my ex-girlfriend in. They paid the mortgage, opened my eyes to real estate. 2.5 years later, bought another house. Market was still low for my parents to live in. Got tired of watching them rent. They didn't want to buy, so I'm like, let me just put the down payment down. You guys get the mortgage, and let's get you into something locked in. We're really glad because they have a nicer house than me, and it was a pretty damn good deal for the time too. I think we got it for $317 in SAC, 2,200 square feet, single story. Probably worth like six something now, 625, 600, something like that. And then I got like just burnt out on like going so slow. So ended up going into this out-of-state thing, buying some cheaper rentals, started doing off-market deals, marketing directly to sellers, got a couple of cheap deals, ran out of money because we bought my business partner, Mike, and I bought a bunch of cheap deals all in like 1 month, right? Like 4 properties for like 15 to 20 grand a pop, ran out of cash. So we're like, fuck it, let's just sell them all. Sold them all and made like $30,000 real quick in that 1 month. And we're like, oh shit, this is more than we actually make with our 6-figure jobs. So we started just finding deals for investors that were looking for exactly what we were looking for when we bought those deals. Good rentals and a process that allowed them to invest out of state in cheap property without having to be present, right? And that got refined into this. So now it's like 2 deals a week. We closed 2 of these properties. Probably we'll do about 100 this year, right? And there's thick margins on them, but they're stable properties in good condition, not like the distressed ones we used to take down 5 years ago. Managers in place, all that stuff. We basically take a flip margin, like 20 to 30% on each of these deals. So it's a beautiful business because it's a flipping company, profit-wise, but we don't hold any inventory. Kind of nice. And don't have to rehab shit. And our customers don't have to deal with that either. And there's no realtors. It's 100% off market. It's just a private network of investors that buy from us. So yeah, lots to process. Come back and take notes on that few minutes if you enjoyed that story. Make more reels with my dog. Fine, I'll make a lot more reels with my 2 dogs. I have 2 dogs. I have a golden and I have a wolf husky hybrid who's 12, who's probably napping in the other room, so I don't bug him right now. What's my take on foreclosures coming back to the market and the impact? I don't know, because here's the thing. That whole foreclosure moratorium, look, everyone fucking took it whether they needed it or not, right? So whether they're gonna actually go and be in enough distress to default on their loans, that's questionable to me. I think anyone who, for you guys that actually took it, you understand. If you didn't, I just looked at the page on Wells Fargo for the forbearance, right? The forbearance program. It literally said on the top of my online banking, apply for forbearance now, because I had a mortgage with Wells Fargo at the time. I refinanced at some point to I think it's with Mr. Cooper now or something like that. Nation Star, same thing. But on Wells Fargo, it said, apply for forbearance now. I clicked the button just to see. And all it made you do was like click yes on 2 things. Like one that stated COVID-related hardness, or hardship. COVID-related hardness is pretty bad sounding. COVID-related hardship. The second one, I can't believe I'm the only one laughing at this right now. The second one, I don't know what the question was. And then once you hit affirm on the bottom, that forbearance kicks in completely. So it was that easy. I bet you a lot of people who actually didn't know if they were gonna have a problem or not with money, or didn't have a problem with money, just went ahead and clicked it anyways and got forbearances, right? And then they collect data around that because those forbearances are in place. Some people continue to pay during their forbearance, by the way. Is that data being processed by all the people that say so many houses are in forbearance? Probably not. Knowing how data and data interpretation works. News sources suck at that. They're really, really bad. Yeah. I shouldn't have made that comment. It was by mistake. It wasn't deliberate. But tons of forbearances that probably aren't real financial distress is what I'm saying. No one's behind me at all. It's probably me in the reflection, and there's a big window over there in front of me that probably has like cars driving by in my street, or on my street, so you can see them going through the reflection back here. Just me and the dogs right now. So anyways, I think the whole foreclosure thing because of forbearances is overplayed. Because even if there is that level of hardship, so you can see the cars driving by, if there is that level of hardship, then banks aren't going to want these properties. They remember 2012, they have big reserves, and there's going to be a ton of federal subsidy to make sure that this doesn't happen. The government will step in, like for sure. They're not going to let 2007 happen again. How do I feel about Michael Quarles? I loved him back in the day because he talked a lot about wholesaling and process, and we even used his service yellowletters.com for a while. He's cool. I don't pay much attention to him. A lot of neuro-linguistic programming in his process. probably because he relies so much on admins to like process all those lucky wholesale deals they get. We're a little bit more relationship driven with the sellers that we get properties from, and a bit more tactile in the way that we pursue these deals. And our salespeople are skilled, right? They get paid well and commissioned well and are expected to like understand real estate investment and have real conversations, and they do. They're not like entry-level employees by any means. So the Michael Kroll's approach to acquiring deals doesn't work for us at all. But it's not our niche either, right? We've carved a new niche that's kind of outside of what most of these companies do so that we can be more competitive. That's my blurb. I'll take one more. These aren't hipster tiers. I missed the hipster tiers, but this is a lot better than hipster tiers. This is some kind of bougie bottle I picked up back in June around my birthday. I think I found it at Costco for like $115 or something like that. The total wine's like $150. Yeah, NLP is, that guy was a little creepy and like really slippery looking, like kind of shiny looking. If you guys have ever seen him. Any experience buying tax liens? No, but I don't love that question. What's wrong with my charger? I don't know what that question is. What brand is my watch? You're gonna laugh. Go watch one of my recent stories. This is a Parnis. It's an AliExpress brand. It looks like a Rolex Pepsi. It's not intended to be a fake. I just like the style of it, right? Which is why I got it, because I don't want to pay $15,000 for a Rolex. It is mechanical. The movement's been really reliable. It's got a sapphire crystal, so like the glass looks great. It is high-grade steel, and it does have a real ceramic bezel. So it's a pretty fucking high quality watch. Like as far as like look and feel, it's obviously not the same quality as Rolex, but it's probably higher quality than a lot of like $300, $400, $500 watches out there. And it looks good. And I love when people ask if it is a Rolex, because then I get to tell them, nah, I could buy like 500 of those, but I don't want to spend that much money on a watch and go through the trouble of trying to find it. And don't tell me it appreciates, because when you buy it on the gray market, you're buying it for that premium appreciated price. And right now people are overpaying for luxuries, right? So they'll probably soften up in value and then go back up a little bit later. But that's not the last question I'm gonna take. I'm gonna take a legit final question. I think I might have found a good one, but I want one that's a little more general to everyone else. Boom, boom, boom. Oh, you started drinking Yellow Spot. That's awesome. Cap rate on that watch, $0. But it was $80. So it's all good. Cap rate on my hairline. Is my hairline bad? Is it going back? I thought I had a lot of hair. Let's see. What's the name for the cost segregation site? KBKG. I think I saw a good one. Let me just pull it back up. What age did I accumulate 100K net worth? 24. But let's take a serious question. Tips to efficiently create a process to wholesale remotely as a beginner. Here's the best tip I can give you. It's all about the product. All about the product itself. You want to chase after, you want to really define, characterize the ideal product, the one that's going to convert, the one that's going to close easily and make you a lot of money. And then you want to pursue that specific product only. And then your process will not matter as much. Competition will not matter as much. Buyers will be easier to find for that particular product, right? If that's the strong product that you've used to, or that you've used the buyers to identify that strong product in the first place, right? So it's gonna be easier to make money when the product is right. A lot of people get wrapped up in adding all kinds of shit to a list that might be a deal, that they have to get really lucky on, that ends up taking all the time from them that they could use towards the stuff that actually is gonna be a deal. And that's called clogging the pipeline, right? So what you wanna do earlier is you wanna keep your pipeline really clean and really lean so it's not clogged up because you don't have a lot of resources to take on difficult deals, lots of volume, things like that. So I'm not gonna talk to you about the process. You can develop that on your own. And I've made lots of videos on like our process, and that should give you an idea. And also just buy the fucking due diligence process guide. It's $35. And it gives you basically our whole like due diligence over the phone process for when sellers call in. So you might enjoy that one. But the product is the most important thing in your business, in this particular business. All right, y'all, I'm gonna get out of here. I'm definitely gonna load to IGTV. I'm gonna enjoy the rest of this drink. You guys have a great weekend. Thank you. This is a fun live. I think I like doing it at home, but I don't know if my boss will allow me to leave. My boss, Mike, my business partner, will allow me to leave the office so early on Fridays every day. See you later, y'all.